All right, guys, we are back to the drawing board. Um, I'm going to show you guys some cool stuff that might change your perspective on the market right now. So, when I tell you guys look from midnight to 9:30, look for a pool. Why do you think I'm telling you that? Drop it in the comments. You guys have time. Like, this is going to be the only thing I'm going to ask you guys. Why do you think I tell you to look for a pool between that time? I'm going to answer it in a second, but just comment why you think I'm telling you guys that. I really want to see what people have to say. Okay, so the answer to that question would be the reason why you want to find a pool for midnight to 9:30 is because you want to look for something that's low resistant. Now, if you don't know what low resistance liquidity is, this is not going to be this lecture. I have that in my mentorship down below on the 50% discount, but I'm not here to teach the basic. I know a lot of people are joining that are just new to ICT. That's not what this is for, okay? This is to help you guys who already understand some ICT concepts put it together. This is not to take someone from ground zero and turn them straight profitable. It can, but that's not what I'm trying to do. I'm trying to do what I wish I had when I first started, which was just help on understanding how the hell to use these concepts. That's all this is. I'm not trying to take someone from zero and bring them to 100. I'm trying to take the person that's at like 50 to 60 and just give them the rest that they need. And this is it. So the reason why I say look for a pool is because you need to find low resistance liquidity, which means if you see a pool forming between midnight to 9:30, which is here, then you know price is setting up low resistance there. So at 9:30, I tell you guys, let it run out liquidity. So when 9:30 runs liquidity and starts breaking higher, you know it's going for low resistance liquidity here. Now, when you have the opening range gap on your side, which would be from here to here, once you have that opening range gap, that right there is going to seal the deal. Like that's going to tell you, okay, there's an actual gap in the market that needs to be filled. So you have a gap, you have low resistance liquidity, you have time, and then you have everything forming around time, which is the 9:30 or 8:30 going lower, the pool up here. And this is going to separate the people who think price is an algorithm from the people who think it's not. So if you're not subscribing to this, you're clearly not understanding it's an algorithm. If you are subscribing to this viewpoint, then this stuff is going to make sense. If you're over there like, oh, why do I need to find a liquidity pool between midnight to 9? I just explained it. You want to see if the day is even setting up to go higher. Vice versa, if you want it to go lower. If you want price to go lower, you want to see 9:30 go higher. And the whole point is because you want to see if it sets up low resistance. That's the first thing to your checklist. Is there liquidity? There's always going to be liquidity, but I'm saying, is there an obvious pool in liquidity? Because if there is, then you're qualified for a trade idea. So looking at midnight to midnight here, you can see 24 hours here. And if you want the day to go bullish, you want to see some sort of manipulation to the downside using time-based models. So what would make us want to be bullish in this day? Like I tell you guys, from midnight to 9, find the draw on liquidity, which would be relatively equal pools. So if this is midnight and this is 9, you want to look in between this window and try to see if you can find a pool. So you have a pool here. And you have previous sell side that resides here. And this model is just this simple. I'm telling you guys, it's just if you guys can spot this before it plays out. And here's the thing too. If you guys were bearish this day, let's pretend you were bearish. Let's pretend you were looking down here for this low to go. If 9:30 is not opening up and taking that, or if you're not seeing manipulation to the upside, don't even look for that low. So what that means is if you want price to get above these highs, you want to see manipulation occur at 8:30 or 9:30. That's just a general rule. And then you have a opening range that's usually going to support that. So from 15-minute, we'll drop down to 5. On the 5-minute, you can see there's a pool here with a open for value gap. Majority of it is open, so it's likely to get filled. So we have a pool right on the low end of this for value gap. We're coming up on 9:30 and we're looking pretty bearish. So 9:30 would be here. And if you guys want a checklist, it's this simple. So get ready to write your checklist. Mark out from midnight to 9. Find the pools of liquidity. Let price go the opposing direction from your main pool. So this is the main pool. This was the only pool. You want price to go against that at 9:30 or 9. Or if there's an 8:30 news driver, you want it to be at 8:30. So if you have your pool up here, you want price to run the opposing direction. The reason is so people can start shorting this leg, trying to catch the trend. And then when it shifts, you get that breaker here. So all the people selling, trying to chase this short, they're getting ripped as price is coming back up. It's not just a stop out, it's liquidity. Everyone's trying to short this leg. Another thing you can do to get on side is use your opening range gap. And how do you do that? You toggle to this. This would be your opening range gap. Right here. We'll make this yellow so it's a different color than my cibbies, or orange. So this is the 9:30 candle. You can see that there's an opening range gap like this. So price is likely to trade into that. So price trades into it, fully goes through it with a bullish for value gap after a market structure shift here. This would be a good long. Up to these highs here, taking most of your profit out. And here's another tip. This is just going to be a price action tip. It's not necessarily going to be much time-based things, but you'll see it's more time-based than you actually think. So how much times can a fair value gap get hit? And you're going to see this a lot, and I might show you one more example. So you see how this is a pool? Price bounce on this fair value gap 1, 2, 3, 4, 5, 6, 7, 8, 9 times before actually hitting the draw. So what that means is no matter how much price is going to bounce off a fair value gap, if it's destined to go higher, it's going to go higher. And that's what it's going to do. So that's why it's good to leave your stop in place and just full pull to your draw sometimes. But you have to have more narrative and context on why price would want to hold in this fair value gap rather than using it as an inversion. And there was an example in the other day. Dropping down to that 1 minute. You have the bullish 5-minute fair value gap here. And we can refine that down to this. And this was your entry here in the macro. This is when you trade a macro. This is exactly what I was telling you guys. When do you trade the 950 to 1010 macro? How do you know? The only time I trade a 950 to 1010 macro, okay, is if liquidity gets taken at 9:30. That's it. So basically here is the window I'm referring to. Liquidity is right here. So how does the 950 to 1010 macro actually work? Well, you can see we dug into liquidity here. We have our draws up here. So these two levels are where we want price to go. So the macro window from 950 to 1010, the only time I trade this is if we have not touched our final draw. If we haven't touched our draws and we're coming in on a macro, your fair value gap is high probability, because that's what it's meant to do, is start spooling to liquidity. So if you have liquidity open after 9:30 runs lower or 9 o'clock into sell side, this is high probability. You guys are literally still trying to trade a macro after it already takes liquidity. You guys are like, oh, the macro's coming. Bro, forget the macro. The macro is only good in this type of a circumstance. And I think I explained that in my last video of like why I disregard macro sometimes. In this case, I would trade a macro. In this case, the macro was easy. You seen it coming and it played out. The 950 to 1010 macro was here. This window. And your checklist for a macro should be a liquidity sweep, which you got that here. Displacement, which you got that. And then a fair value gap to a draw. And this is how you frame that 950 to 1010 macro. And if you want your 1050 to 1110 macro to work, you want an 830 news driver. That's something I'm going to drop in this video. I don't talk about that much, but if you have an 830 news driver, you want your 1050 to 1110 macro to play out. So from the 1 minute, we're going to cut price back to here. And looking at regular trading hours, do you see a gap higher? Do you see price gapping higher? Yes, you do. There's clearly a gap higher. So looking at this blue box, what is this blue box? It's my gap from the previous day. What are these dashed lines here? It's sell side liquidity inside of the gap. So this is high probability. So what does that mean? That means when you see breakers form, fair value gaps, and change in states, it's high probability. You're never going to be 100% right, but you're going to be in high probability conditions or low probability conditions. And when you start to see things like this, you can just exercise your risk to reward and trust your trades and let them play out. So we're going to head over to the Discord and I'm going to show you guys some things.